Lenders 20 Questions on Pass-Throughs and K-1s, video number 14. How do you calculate cash flow from an 1120S K-1? Well, first of all, there's part of their cash flow that the S-Corp shareholders receive that's already in their 1040. The wages, if they receive wages and work for the company, if they rent the building to the company, the rents are already in their 1040. If they have a note or contract receivable, the interest income from that is already in the 1040. But what's not there at all anywhere, and that you have to have the K-1 to get, is distributions. Now that's line 16 with a code of D, although as with everything on the internet, always check that line numbers have not changed. Those are the distributions to the shareholder, and let me explain to you how common this is. It is really common for an S-Corp shareholder to make a decision that they don't want to take all the money they want in the form of wages and would rather split it between wages and distributions. Example, if you have a shareholder who works for the company, they want $100,000 out during the year, they might pay themselves $40,000 in wages, which is what you saw in the 1040, but another $60,000 in distributions. That's going to save them in payroll taxes, maybe as much as $6,000. So you really do need, with an S-Corp shareholder, to consider what's already in their 1040, but you gotta go look at that K-1 to pick up the distributions because they can be very significant. There's one more number that not every lender uses, and you need to check your guidelines to see if you can, but in that same spot, line 16, but with a code of E, is repayment of loans from the shareholders. Now, traditionally, lenders have sort of shied away from counting on payments on those loans to the owners. But let me give you a little different scenario. What if, during a downtime or an expansion or a recession, the owner lent some money into the company? In the most recent year, the company has done well enough to repay those payments and has been doing so. And then once the loan is paid off, wouldn't the money that's been going to pay off the loan be available as a distribution to the owner? I think maybe so. So consider line 16 code E on the 1120S K-1. If it's within your guidelines, you might consider counting it. If it's not within your guidelines, as is almost everything else that might make sense sometimes but not always, still take a look and consider whether it's a compensating factor that should come into play in getting you to yes on this loan. If you enjoyed this information and you would like to receive all 20 free videos of the top questions lenders ask and should ask about business, personal, and global cash flow from pass-through entities, along with a copy of my tax return analysis quick reference guide, visit the URL on your screen.